Let's talk about trading structure breaks using just simple price action and maybe one indicator for entry. So good afternoon, everyone. This is Forex Brizio. It is 3 p.m. on Saturday, June 3rd, 2023. Hope everybody's doing great. Recently, a pretty quiet week in the market last week, which is not surprising. It was a holiday week coming off Memorial Day in the U.S. and kind of like the unofficial begin to summer, and so it's generally a pretty quiet week, and it was really hard to get a lot of trends moving, although Friday was better. At least the early part of Friday was actually better, and I guess part of Thursday wasn't bad, but overall it was a pretty quiet week. Monday was, again, U.S. markets were pretty much non-existent with the holiday, and then Tuesday, Wednesday were pretty quiet, so it was just generally harder to get trends going and sustaining. Anyways, and the summer does tend to be a little bit lighter in volume, so you do kind of have to adjust some of your expectations in terms of profit targets and how far trends might move in the summer, because the volume just isn't there. You have a lot of your large traders and hedge funds, and just the big bank traders that start taking holiday time, vacation time over the summer, and that does tend to draw out a lot of the volume. So, but it doesn't mean there is no opportunities. Just be patient. And, sometimes you may have to temper your expectations as far as how far you think a move might go. So, but anyways, that's not what this video is about. So let's just talk very simply about structure breaks, and whether you want to call this supply and demand trading or just simple price action structure breaks, probably closer to it, then that's fine. Although I am going to show you one nice demand trade that I took on the futures trade this week. I only took a couple of trades in my futures account this week, but one of them I took, I think, on Thursday was actually good. Anyways, so let's talk about this first. So, now, again, guys, you can do this on any time frame. It really, really doesn't matter. You can find these setups on anywhere from a 1-minute chart up to a monthly chart. Okay, but this is an hourly chart. This is the Euro Aussie, and this is one that just kind of played out recently. And so let's talk about this. So you can see we had a downtrend here. Okay, and then we broke some structure up here, kind of consolidated. We started moving higher again. Okay, and we had this move up, and you can see we had this uptrend, and this was where I drew this line. This was essentially the last swing low before this last high was put in. Technically, if you wanted to be really technical, you actually could have said this is it right here, because this little structure area here before this little high was put in, you actually could use this, but let's use this one because it's a little bit more obvious. Okay, and in hindsight, this one looks good, but in real time, this just looks like a little pullback that could have just kept going higher. But this was an obvious swing zone right here, right, where price, tested demand and kept going. But I will say, in full transparency, you could have used this, and that would have worked out fine for this trade too. But let's just say you're looking to be a little bit more conservative on where your structure break occurred. And so right here on this chart, you can see price came down here. We were in this nice uptrend. We had this last swing. Price came up, broke this area, okay, and then went all the way back up to the last high, and then finally it broke down. Okay, so what you don't want to do is, most of the time, guys, you are going to find on these structure breaks, you're going to find the price is going to pull back and retrace, and usually pretty significantly. At least, I would say, if you want to use Fibonacci, at least a 61 or a 78% retracement level, right? 78.6, 61.8 fib levels, okay? But oftentimes, depending on the pair, you may get 100% retracement, which is what happened here, okay? And so you can't really have FOMO, guys, because if you had taken this, let's say you went short right here. Oh, great, I got the structure break. I go short right here. Well, then look what happened. Price did move down a little bit, moved down about 30 pips from the close of this first bearish candle that closed below, And this is the structure, right? There's this nice candle right here. These are just wicks. These little tiny candles right here I like this, like these nice engulfing lines like this. Okay, and of course you can go to a shorter time frame and really see this, but let's just stay on the hourly chart. So you would have gone into profit 30 pips, like 38, 35, whatever this is. You're like, oh, good. And then all of a sudden, boom, this thing turns around and shoots back up again. And you went into 128 pips of drawdown, or more than likely you got stopped out because you probably had your stop sitting, maybe above this high or above this high. Either way, you got stopped out on this, right? Because I doubt very much on an hourly chart you would have had 135 pip stop loss in place, which is what you would have had at minimum, probably even more than that, maybe 140 to withstand this big drawdown, right? So you either have to, if you're going to get in at this really bad point here, you either have to really manage the trade and have a very small lot size compared to what you normally would trade with to start with to allow for this pullback, or you're going to wait for the pullback. Now, the pullbacks can really vary because see this one right here, you would have seen this pullback right here, and then all of a sudden you see it start going down, you see this red candle, and you're like, oh good, the pullback's over, and then you jump in right here, again you get about 25 pips into profit, and then again you go back up 120 pips in drawdown, probably stopped out. So whether you took this one or you waited for a first pullback and you took it on here, thinking that this was your entry, and you still had 100 plus pips of drawdown and a likely stop out, because in this case you probably put your stop above this swing, it came up here and took you out right here on this candle, and that's it, only to see it, and then continue to chop up and then eventually see the bottom fall out, which is what you originally thought. So again, your theory was, your analysis correct, your timing was awful. And that is the case that happens many, many times. And that's due to, honestly, guys, it's psychology and FOMO. That's all it is. It's not your analysis. Your analysis was right. You just didn't want to miss the trade, and the big banks know that, the big traders know that, and they fool people into this by having these sucker punches here where they're not ready to take the price lower. They need more liquidity. They need more liquidity to fill all their orders to take this thing lower. And they're not going to get it down here. Right? They're not going to do it down here. They need to suck more people in. They push the price back up. People think, okay, price is going higher again. They jump back into long positions. They have their stops down here. They jump back into longs, or they sell here, put their stops here. So these become buy stops on the stop losses, and they're just looking to grab as much liquidity you can. They know there's a bunch of orders sitting up here. Breakout traders are sitting up here, for price to go higher above this high. So there's a bunch of buy orders, and they tap them right here, trigger off a bunch of longs, and then boom, they slam it down. All right, it's a nasty trick, but that's what they do, right? So you don't want to be part of that. Okay. So, but the question then becomes, well, when is the turn going to take place? Well, you could wait until price comes down and takes out these lows again. Okay, you could say, okay, well, I'm just going to leave this, and when price takes out this swing down here, this was the last low that was put in. You could say, well, I'm just going to wait for price to come down, close below here, and then I'll go short, which would have happened on this candle. So you would have gotten in somewhere between here and here, depending what time frame you entered on. Let's just split the difference, say right here. So as of right now, you'd be up 120 pips. Still, hey, pretty good trade, right? But let's say you wanted to get an ideal entry somewhere further up here, because in this case, if you'd gotten in here, you left potentially 160 pips on the table. And the chances are you wouldn't have gotten all of that, but somewhere up here you would have entered and still could have had an extra 100 pips in your pocket at this point. Okay, so there's the one thing you can do if you don't want to keep jumping around on time frames is you could add some kind of oscillator to your chart. And again, guys, I'm not big on using a lot of indicators anymore, but so I'll just bring this one up here. This is the relative vigor index, which is in MetaTrader. It's probably in every trade. It's an old indicator. It looks kind of like an RSI, stochastic, MACD without the histogram. I mean, it's basically what it is. It's a two-line oscillator. And basically all I'm using it for here is a 0 line cross. And that's it, okay? So basically we had this initial breaker structure right here. Let's get rid of this one. We had this initial breaker structure, okay? Now let's follow the oscillator. We had this initial breaker structure, and we can see price starts to trade back up, and here's the oscillator, right? Breaks back up, comes back to the 0 line, back up, back up, back up. And finally, both of these lines, the red and the blue line, cross back. Now let's put a vertical line on here. They both cross back below the 0 line, right about, whoops, but I want it on the whole chart. Okay, right there. Okay, right there. So right there is your entry. Let's put a little check mark. Okay, we'll get rid of this white line. So there's your entry on the close of this candle right here. This is where the RVI crossed back below the 0 line, and you can enter right here. Instead of way down here, you entered way up here. Now, we had a little pullback right here. Price did pull back about 37 pips. That's no big deal. I can tolerate 37 pips. Even if you put your stop up here, 80 pips, it's still a pretty decent stop loss, but it's better than getting in way down here. Now you've doubled your stop loss right here, between here and here, as opposed to here. Then I'd put my stop here and I just let it go. And not to mention, you'd be up 220, about 220 or 215 pips right at the moment, okay, as of where the price closed on Friday, okay? So that is one way to do it. Now, alternately, what you could do is, which is where your supply and demand traders and your smart money people, is you could go down to a shorter time frame and check this area out right about here and see what's going on a shorter time frame. So let's jump to the 15. We'll look at this area. You can see price came up. And then we had this area, you can see these bearish candles coming right out of this zone. Okay, you can see all through here, price never got up to the zone. We did have this one weird ass looking candle. I don't know what this was. Let's see when this was. 4:30, so that's during the London session. I don't know what this was, a news candle. So just ignore this one, because there was nothing coming out. There was no follow through on it anyway. It's a bull candle. Even though it's very weird looking, it actually closed higher. Okay, so we'll ignore this one. But you can see price came right up, tapped back into this zone, into the blue area here, and we had these two big bearish candles, and price went down. So this is another area that you could look to get back in. In this case, I wouldn't use the RVI. I just wouldn't use it here, because you're probably still going to get false entries. Like the RVI said to enter right here. Well, we weren't anywhere near this zone. Okay, we're still 50 pips from this zone. So in this case, if you're going to do it this way, I would just go back to using just pure price action and just say, look, let's just tap into this area and then let's go. The problem is sometimes it's not going to make it back here. Okay, if the selling pressure is really strong, you're not going to come back up here, and you'll have maybe a Fibonacci retracement back here, but it's never going to make it back into here. In this case, this would have worked out perfect. You could have entered right in here. You could have either entered right here, at the close of one of these two candles, or if you wanted to be a little bit more conservative, you could enter, at the break, which would have been back to our original entry on the 1 hour chart, which was right here. On the break of this structure, you take it on the close right here. Remember the check mark, we put this on the hourly chart. This would have been your entry right here. Okay, so there's two different ways to do it, but the bottom line is, guys, that you're waiting for these retracements to happen. The question is always, again, what's the depth of the retracement that you're going to face? When it breaks through here, is it only going to come back to a Fibonacci level, or is it going to come all the way back up 100%, tap this area and go? This is ideal, guys. This is a golden zone. If this happens, and you get confirmation this thing's going down in this case, man, I would load up on this trade, okay? Because this is a very high probability trade, and since price came back up here, you have a very small stop loss, right? To, a few pips above this zone, you've got about a 10 or 11 pip stop loss, to give this thing a little breathing room, with the spread and everything. And you get a 10 or 11 pip stop loss to make, 200 plus pips. So what is that? 20 to 1 risk to reward ratio. It's craziness, right? So that's why I just want to point this out. Now, again, guys, you can find these setups on any time. You could go down to 1 minute. You could find these things. Now, I wouldn't do that because it's just, to me, it's not worth it. You have to stare at the charts because you never know. Price is going to turn back again. And, if you're not watching it closely, it's just, to me, it's not worth it. So I prefer to do these on a little bit longer time frame, 30 minute, 1 hour. I like to look for the setups in there. Sometimes I'll go to a 4 hour because, obviously if it's a 4 hour trade, you definitely have to allow for these pullbacks because your stop losses are going to be even wider. I mean, I said this was like 130 pips from here. Well, on a 4 hour chart, it's going to be a 400 pip stop loss. So you definitely, the higher you go up, the more you have to allow these retracements to happen. Otherwise, you're going to get brutalized with drawdown, and you probably won't even take that amount of drawdown. You'll either close your trade manually or you'll get stopped out long before that. I mean, let's be real. Who's going to take a 400 pip drawdown on a 1 hour chart? I know I wouldn't. So, but you don't have to because you can just wait for the pullback. And either, again, use your shorter time frame to look for the entries, or if you want to just make it a little bit simpler, use something like the RVI. Now, I've tested different oscillators. There's a million oscillators, guys. Even just in your MetaTrader platform, the oldest, clunky, antiquated MetaTrader, there's a bunch of oscillators included. And, of course, you can download a million other different ones. Or if you use TradingView, there's 1,000,001 oscillators, okay? But I've tried like CCI, MACD, RSI, stochastic, Williams, %R, awesome oscillator, the Bill Williams awesome oscillator. And I find, something like the RVI, which is just a classic old oscillator set to the default, which is 14 periods. I didn't change anything. It's just a 14 period RVI. And that's it. And this one is slow enough where you should get minimal amounts of false signals as long as you stay on a high enough time frame and you just wait for this thing to cross below the 0 line. And as soon as you see it cross below 0, then that's your entry, okay, on the pullback, which again in this case happened right about there, okay, right in here, basically the close of this candle. I put my stop up here. We did get a little pullback. That's fine. This is even a better entry, and then it went. Okay, but like I said, sometimes you're not going to get that full retracement. If we look at this pound US dollar, we had price coming down here. We had this strong rally out of here. We had this price break above structure, and you can see price then came all the way back down, but we did not get a tap back into this zone right here. Okay. There was too much buying pressure and price never made it back here, okay? So if we put a fib on here, probably going to find 78.6, yep. Exactly, pegged the 78.6 and then boom, went. So if you were waiting for this thing to come back into your, let's say you saw this breakout, okay, I'm waiting for a retracement, and I want this thing to come all the way back down to the origin. Well, it never got there, and you would have missed out on a beautiful trade. Because if you had gotten in somewhere here and even just held it to this high, that's, 172 pips, and you left all that on the table. Now, if we look where we are currently on this pair, you can see I have a fib drawn on here. This was the last kind of demand zone we've pulled out of here, and now you can see we're coming back. And you see I got a couple of arrows drawn on here because I am expecting this thing will bounce from here. And so I'm going to watch this zone and this zone. Here's the 100% back to the origin. And here's we're kind of in that golden zone right now between 61.8 and 100. We're in that zone right now. So when the market reopens early next week, not on Sunday, but I'll be watching for a price to what it's going to do as it gets down into these levels, to here, and then if it happens to break through the 78, then ideally I'd love to see price get into this blue zone and then shoot back up. So anywhere from about where it is now down to here is a potential good setup on the pound US dollar. So if we put I don't have the RVI on here. I'm not going to change my template because I don't want to lose all my drawings. So we'll just put the RVI back on here. All right. So here's the RVI now, and you can see right now, obviously it's way down below the 0 line. So as this thing turns and comes back up again, okay, when it crosses back through the 0 line, this could help me find an extra confirmation. Now look, if it gets down into this blue zone, I don't even care about the RVI. I'm just going to look for a bullish candle pulling out of this zone and I'm in. That's it. I don't care what this thing says. But if it doesn't get that far and it just kind of drifts down a little further, starts to turn back up, this RVI will catch up pretty quick, okay? And then as soon as it crosses this 0 line, I'm back in, okay? I might do this on a 30-minute chart, okay, but I like the hourly chart. Okay, and now if we look over here, we go back to this previous one, right? What did I say, right? It didn't get, we never came down into this zone right here, right? The RVI crossed back above, okay, right about here. So this would have been our entry, okay? We did leave a little bit on the table here. We probably left from this breakout candle. Whoops. Where did it happen? Right about here, close of this candle. You know, if you waited till, realistically, you probably would have wanted to see this candle. So you left maybe 20 pips on the table. That's okay. And, but you still would have made, if you had held it right to the top here, you still would have made 128 pips on this move up. Okay. So that's, another way to use the RVI. Because again, we didn't get a pullback into this original breakout zone, this demand zone down. It just didn't make it. It's a perfect Fibonacci. And you can put a fib on there to help you. But if you see it start to turn, then watch the RVI instead. Now, the other thing you could do again is go to a shorter time frame. If we're looking at this area right here, go to a shorter time frame and look for a structure break to the upside here. So if let's put another little check mark there, right there. Okay, let's drop to a 15. All right. So this really would have been about the same entry. We came down here. Here was the last swing on this up move. So right here, and this candle would have been the break of structure. But you can see it came down and retraced. Okay, it's not really giving you really much better of a signal than what we had on the 1 hour. If we come down to a 5-minute chart, again, here was that bottom right here where the check mark is. Our structure break really happened right here. So, maybe to come down to a 5, but I mean, these candles are so small. It's just, in hindsight, it looks okay, but you really don't know. So that's why, I don't lose too much sleep over this kind of stuff. I'll just use the 30-minute to the 1 hour. I might leave a little bit on the table because I've gotten a little bit later entry, but I just, I'm probably not going down shorter than a 15-minute for my entry. All right. I just assume just see this stuff, and I'm looking for these, I'm looking for these structure breaks on the higher time frames. Again, the 1 hour is good. Again, because you can see here we had a downtrend, right? A very clear downtrend. Lower highs, lower lows, lower high, lower lows, all the way until we hit here. We made this new low. We came up, came down. This is your first. So let's look at this again really quick. This is kind of your first warning sign right here, right? We made this new low right here. We came up. We took out this structure, then price started coming down, like, okay, maybe it's just some aggressive liquidity grab. I'm not necessarily looking to get into this long right now. Even though it took out structure, this is actually a valid area right here. Okay, because then you see aggressive price and say, okay, well, it's going to go down. But you can see it stopped right here. We never even came back to this low, and then we went into consolidation. This is your first warning sign that this downtrend is going to reverse, at least for some period, because we failed to make a new low. We went into consolidation, which means there's a lot of accumulation going on right here, right? The sellers have pretty much run out of steam. They're being chased out of the market, and the buyers are starting to accumulate positions here. And then we tapped some demand here and then went up. And so as soon as you see this pull out of here, this is definitely now the game is on for longs, right? Because you had a very impulsive move out of this zone, right? They accumulated their positions. Boom, here was the first pull out, and then the retrace to grab some liquidity, and then go again. Okay, pull back again, and now, let's see what this does. Okay, So this is what I'm kind of looking for. I'm looking for these trend changes where you see a clear reversal, some bullish price action. As I said, even if you ignore this one. But even if you ignore this one in real time, like I said, because it took out this high, technically it did take this high, took out this high. So you're like, okay, well, this is a structure change, but then it's immediately followed by a down move. But as soon as this down move runs out of steam right here, okay, and it doesn't take out this low and price kind of runs out of steam, now I'm watching this really close, and we start to see it consolidate. I'm watching it, okay? So this is kind of the origin of all of this happened right here, okay? But assuming you didn't bother with any of this because you weren't really sure at this point, you wanted to see this and then the retracement, that's fine. Because honestly, what did you gain? If you had gotten in over here, you didn't really gain anything, right? Because ideally this was your entry. So even though this was kind of the warning sign of the start of the end of the down move and the beginning of an up move, you really wouldn't have gained anything by getting in here any sooner. Even if ideally you got in down here, well, the difference between here and here, yeah, it's maybe 15 pips or so, but, you know, so like I said, you didn't really gain all that much. But this is the warning side. This is when you say, this is where I'm going to start watching this pair right here. All right? So that's it, guys. You know, so it's a little bit of supply and demand. It's a little bit of just price action and structure break, and you know, using some fibs, using some price action, using one indicator, the RVI in this case, to help you, you know, plan those re-entry zones, especially if price doesn't make it back into the original demand or supply zone. In this case, the demand zone, it didn't make it back here. So where's your entry? You can use the RVI to help you plan that when it crosses back above the zero line. And so again, that's what I'm going to be kind of watching here. Okay, though I will say, just eyeballing this, because this move down was so impulsive, this is a 14 period RVI, which means it's looking back at the last 14 candles. It's going to take a little bit to get this thing to bend and come back above the zero line, because it's looking at the last 14 candles, right? 1, 2, 3, 4, 5, something like that, 6, 7, 8, 9, 10, 11. It's looking at all of this, and these down candles right here are going to take a little bit of averaging. So you can play around with the RVI setting. I mean, you could make this shorter instead of like, you know, instead of a 14 period, make it a 10 period. But if you do that, you may generate more false signals, though. But if I make this like 10 periods, right now it's not going to make much difference because of that down move. But, you know, so it just, so you can see it doesn't really make any difference at all. But you can play around with the length of this thing. But again, the shorter you make it, the more potential false signals you're going to get. Okay, so you just got to be cognizant of that. Okay, but yeah, that's a nice way to do this, guys. And so that's really what I wanted to show you today. If we're looking at some other things really quick, here's the pound Canadian kind of heading back into a demand zone. Okay, so again, we had a structure break, right? We had a structure break here. It's kind of the same thing, although this one ended up going higher. Structure break, you can see price went all the way and made a new high, and then finally it broke down, and we're heading back into this zone now. All right, so here's the pound Kiwi. You see I drew this out. You know, we're making this uptrend. We had a structure break right here. Okay, now this thing might, the way this looks right now, this thing could just break lower, so that's why I have this arrow here. But we very well might see this thing come all the way back up here, okay, and then go, okay. So let's see what happens with this one. I do think this is definitely going lower. We have a clear structure break on the hourly chart, but the question is, are we just going to go, or are we going to see a nice pullback from here before it goes lower? This is the pound Kiwi. This tends to be pretty violent and volatile, so I wouldn't be surprised to see a big retracement on this, but let's see what happens. So this is definitely one I'm watching, but I think ultimately this is going down, at least back down towards the origin of this initial breakout down here. This, if I did get into this trade, this would be my target. With this huge blue candle right here, there's a lot of imbalance here. There's probably a lot of orders left sitting way down here. We had this little quiet accumulation, and bam, right? So did they get all their orders filled? I don't know. We can see this thing come all the way back down here. But I'm going to be, patient on my entry though, right? If I just see this thing start to go, bearish candle here, another big bearish engulfing candle, I might just jump in straight away. But I wouldn't be surprised if we see this thing, break back to the upside and come all the way back up into this zone, maybe even back to this high again. And then this would be a sniper entry up here, right? Somewhere up in here, right? That would be the ideal. Well, let's see what happens. If not, if we get a shallower retracement back up, 61, 78, then I'll put the RVI on here and I'll use that, right? So that's what I'm talking about. And that's it. So I did want to talk about this trade. I mentioned at the beginning, this is the Dow futures, the micro E-mini Dow June contract. And you can see this is for you supply and demanders, this is a perfect trade, but it also is a price structure breakout. But you can see we had this downtrend. This is the 30-minute chart. You can see it on the hourly chart too. Here's the hourly chart, right? Down, 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 down. Then we have this structure break right here, right? Price kind of bottomed out right here. All right, we started moving back up. Okay, took out all the structure. We took out this structure. We took out this structure. Took out this structure. We gapped higher right here. This is definitely telling you things are going higher with this gap. You don't see this really in Forex, but you will see it sometimes in futures. And then there you go. And then what did we do? We had strong impulsive move, very few candles to get up to this high, and then we had this meandering correction all the way down, tapped right back in here. Look at this candle, tapped perfectly into this zone, this little red wick right here, and then boom. Okay, and I did take this trade. I got in, I think at the close of this candle. I did close it on Friday somewhere. I think I got out when it hit this high back here. I got out like somewhere here. It did creep a little bit higher, but I got out up here. It was a great trade. This is a perfect supply and demand trade, all right? But you just don't find these textbook ones like this very often. I mean, you can scroll through your charts and look for them, and you will see them once in a while. But this is textbook. I mean, if you're just scrolling through your chart and like, holy shit, all of a sudden you see this setting up, where you see a downtrend followed by a structure break, and somewhere in here you're seeing, meandering price heading back down to the origin, and you put this thing on your watch list and you watch this really closely, because chances are you're going to find this. And the futures ones do tend to work out better, where they actually will come back into the demand zone in this case. Whereas on the Forex, a lot of times it's going to hit a fib level, but it might not come all the way back, but you'll hit a fib level. But in futures, you do often see these things work out where they come exactly back to the origin, because it's just the manipulation. Not that there isn't price manipulation in futures, because there is, but it's a little. They can be more clean sometimes. And this was based off there was employment numbers on Friday. That's what this was. This actually goes back to Thursday, I think. But this was non-farm payroll, the aftermath of the U.S. employment numbers on Friday. So, which is, because the employment numbers are good, it was considered good for the stock market. Although there was a little uncertainty at first, because good employment numbers that potentially could lead to more inflation, and therefore that's actually bad for the stock market because they could raise interest rates again. But anyway, this was a perfect setup. So take a picture of this one, because this is great. And if you see something like this setting up, man, you've got to be all over this. All right. So I did want to show you that. All right, guys. So I think I'm going to leave it there. We're at 34 minutes, way longer than I wanted to. So I apologize. But I hope that's clear, guys, and it's just a way for you to look for some opportunities. Again, you can do this on any time frame. I mean, you can look for these type of setups on a 5-minute if you want, but to me, you have to be able to manage those trades pretty closely, and if you're not sitting there staring at the charts, you can have those things reverse back on you, and, I don't know. To me, I'd rather have something. I don't mind having these only be day trades to short swing trades, but I don't want to have to look at it every 2 minutes. I want to just be able to set it, manage it a couple of times during the day, just keep an eye on it and, look at some structure areas where I might want to set profit targets, and, and that's it. All right. But again, you could do it on a 5-minute. You could look for these setups on a daily chart, a weekly chart, a 4-hour chart, whatever you want, whatever your comfort level it is, however much time you have to look at the charts. And that's the beautiful thing about these. They're all fractal in nature, and you'll see them setting up everywhere. So here's a little supply and demand trade right here, although price went past the origin. You can see right over here, guys, we had this downtrend. We had this big breakout right here. Here was the origin. Price did get below here, right? It did dip below here. But then eventually it did shoot up. So, right? So down here, okay, breakout, back into demand. It just happens to be a little bit lower. I bet you if you went to a higher time frame, there probably is a demand zone off to the left here on, say, maybe a 4-hour chart. Sorry, I don't want to extend this video anymore, but here's that area right here. I mean, it's not really obvious, but this technically is a supply and demand, right? Downtrend, impulsive move away, taking out multiple structures, and then the big meandering corrective move back down again, looking for that point of re-entry, and then boom, finally it went. Okay, and so now here we are working back down again. So, all right, guys, so a little bit of supply and demand, a little bit of structure break, simple, just using price action and maybe one indicator to help you out in case you don't get back into the origin of the breakout. All right, then using that RVI can help give you a little bit more confidence on where your entry should be to get back in, so you don't get sucked in too soon and end up with a big drawdown or a stop out, only to have the trade go in your direction at some point. All right, guys, questions, comments, please leave them below. Let me know what you think. Smash that like button, help out with the YouTube algorithm, and click subscribe if you're just finding the channel for the first time. And that's it. Okay, nothing ever for sale on this channel, just my analysis and some ways to look at the market, and you can use these methodologies in any asset class that you're trading. Okay, I happen to do Forex and futures, but if you're a stock trader, great. If you're, doing crypto or whatever, go for it, and you can probably use this in, like I said, any asset class. All right, guys, have a great rest of your weekend, and we'll catch up and hopefully do some review on a couple of these next week. Take care. Thanks.